The broadcast is now starting. All attendees are in listen-only mode.
All right, good evening, everyone. This is Neil Green again with you on the weekly webinar. Hello, folks. How you all doing? Okay, would like to welcome you guys joining us from our website at on GoToWebinar to this webinar, just like every week at the same time. Doing these webinars at 6 p.m. GMT time for you to have enough time, to get back from work, have a seat, and listen to the weekly update on the markets. Guys, you have a chat window. If you have any questions, anything you would like me to clarify during the webinar, you're more than welcome to write me down. Would like to welcome you guys joining us on Facebook. All right, so welcome everyone. Today we're going to talk about, hey Kathy, how you all doing? Everybody can see the screen, you can see our homepage and hear my voice. Are we good? Can we start? Just want to do a technical check, just like, okay. All right, so good. All right, so this time we're going to talk about some correlation trading. All right, a lot of times people tell me every webinar you say it's a very important thing to diversify your portfolio, not put all the eggs in one basket, trade on a few assets, build a portfolio, lower the risk. Risk management is about lowering the risk by splitting my trades and not put all the eggs in one basket, as I said. So this is one thing that is very important, and I would like us, to do that. And you can use correlation in order to understand. It's very important in order for you to understand the correlation between the assets. Okay. So if I want to take a few trades, I want to see how the assets that I want to trade with are they correlated, positively correlated, negatively correlated. Okay. And I'm gonna teach you about a few assets and how it works in order for you to know how to trade, first of all, in general, and then second, we want to know how to trade assets during events. Okay, so of course we always have the technical trading, but let's see how we can use these correlations. So let's start. Okay, correlation trading. Correlation trading involves at least two different assets, of course, right? Because we got to trade on the difference of the prices between assets. Okay, these assets could be correlated in a positive, as we said, or a negative way. Correlation tactics help traders diversify and hedge positions. Okay, hedge position, when I take two assets, for example, that have negative correlation, when one goes up, the other one goes down. Okay, and for example, I take them both to the same direction. It doesn't matter if I go a long position or a short position, which means it doesn't matter if I go buy or sell on both of them. Okay, for example, if the price of both of them is going one way and I'm getting rid of the losing position, so I'm with the winning position. Okay, this is what hedging trading is all about. Smart trading, by the way. And most correlations are valid only at specific period of times, and we're going to talk about it. All right, so let's go on. Okay, let's take a few examples for correlations. Okay, let's talk about a few examples. Now, the famous one is the gold versus the US dollar correlation. Okay, I talked about it, I think, in many webinars. Today I will explain the reason. Okay, gold is priced in dollars. Therefore, when one rises, the second drops. Pretty easy. If I want to buy gold, okay, I buy it with US dollars. You're gonna see the symbol is XAU, stands for gold, versus versus USD, okay, which is the US dollar. A strong NFP, for example, a good interest rate decision, any anything that supports the US dollar, like a strong NFP, for example, usually pushes the US dollar higher while gold drops. Now, let's try to see. Let's try to take an example. Okay, you know when the last NFP took place, the NFP we talk about the non-farm payroll. Okay, I talked about it in the past webinar. Takes place every. I'm just giving you an example of one event in order for you to understand the negative correlation between gold and the US dollar. Okay, so the last NFP, when was it? Any idea? Anyone? Okay. It takes place every first Friday of the month. We're talking about the non-farm payroll, okay, which is after the interest rate decision is the biggest event in the United States. We get the job reports, the unemployment rate, um, the average hourly earnings, and so on. I had a whole webinar. You can find it on our homepage on Facebook. Okay, talking about how to trade the NFP. I'm not going to go into it, but I just want to show you something. All right, the last NFP, as you can see, let me show you. Let's go. It doesn't matter. Investing.com on our website on Forex Factory took place on February 2nd. All right, the first Friday of February. And then we had, as you can see, these three major things that we look at. First was the non-farm payroll itself. We expected 181,000 new jobs during January, and actually we had 200,000 more, which you see it's painted in green because it was better than expected. Unemployment rate was, as expected, 4.1%, the lowest that I remember. And average hourly earnings, we expected a rise of 0.2%, and we had a hike of 0.3%. Now, looking at all this information, the details were better than the forecast, better than expected, which means the US dollar. What do you think happened to the US dollar if we have a good report? Right, it rises up. Okay. Okay. Let's take a look at the MetaTrader. Let's take something, a pair of currencies that the US dollar is the major one, US dollar versus Japanese yen. Now I'm going to a half an hour chart. You see, each candle here represent half an hour. And I want to go back to February 2nd, when the last NFP took place, which was February 2nd. There you go. Now you see this candle represents half an hour. You see the dollar got stronger, right? Why? We talked about it. Okay, you see the NFP was better than expected. The average hourly earning was better than expected. Unemployment stayed the same. Everything is green. We expect the US dollar to go up pretty easy. And it went up as expected. Okay, no surprises. What do you think happened to the gold? Exactly during this time, during these minutes. Any guesses? Right? It went down. If gold goes up, okay, I'm sorry, if the US dollar goes up, gold goes down. Pretty easy. Let's go. You see, gold is marked by XAU versus USD. Let's go. There you go. This is the NFP. Okay, so it's very important for you guys to understand the correlations between these assets, because when you want to trade, it doesn't matter if you trade for the long term or if you want to trade a specific event. Of course, you can go into the webinar, ask your account manager, and understand how to trade this event. But when you want to choose the assets that you want to trade on and you want to diversify your portfolio, you want to trade on a few assets, it doesn't matter if you go buy or sell. You just have to understand the correlations between these assets. Okay, so when US dollar goes up, okay, actually any major currency, but especially the US dollar, we expect gold to drop and the opposite. Okay, good. I hope it's helpful for you guys. Okay, let's go back to the PowerPoint. And so examples of we say the famous gold versus dollar correlation. Gold is priced in dollars, therefore when one rises, the second drops, and a strong NFP usually pushes the dollar higher while gold drops, and the opposite, of course. Oil. Okay, let's talk about oil. Oil versus Canadian dollar. Okay, the Russian ruble and the Norwegian krone. Okay, the NOK. Oil is highly correlated with oil currencies. This is what we call oil currencies. These are currencies of export countries like Canada, Russia, and Norway. Now you have to understand, a huge percentage out of these three countries, just took them as an example, Norway, Canada, and Russia. A huge percentage, Russia, I think it's over 50, maybe 60 something percent out of their income, okay, is export of oil, gas, and so on, especially oil. Okay, they are a main manufacturers of oil. Okay, they export the oil, and this is how these countries are making money actually. So these currencies, their currencies, is very highly correlated, positively correlated on the same direction with oil. Okay, so oil is highly correlated with oil currencies. These are currencies of export countries like Canada, Russia, and Norway. A rise in the price of oil is usually related with a drop in the USD versus CAD, USD versus ruble, and USD versus the NOK. And let me explain. If oil goes up, we expect the Canadian dollar, Russian ruble, and Norway koron to go up, right? So because in these three pairs, the US dollar is the major currency, and I took the US dollar because it's the most famous and tradable currency. These three charts are dropping down. Okay, when the ruble is getting stronger, USD ruble goes down, and so on. Okay, now let's take a look at what's going on in the market right now. Take a look. If we go here, okay, take a look at CL, for example. We choose CL for crude oil, the US oil. There you go. Let's put it on a daily chart. Let's take a look at what's going on right now. Okay, in the past 2 weeks, on a weekly chart, you can see it great. You see 1, 2. In the past, the whole market went down, but you see oil prices dropped. Okay, oil stocks as well dropped. The whole market went down. So you can see the drop in oil currencies, right? Which means these three currencies, the NOK, the ruble, what we call oil currencies, and the Canadian dollar, we expect them to go down as well, right? Positive. You understand the difference between a negative correlation, okay, what we saw on gold and US dollar, and what we call a positive correlation, which means two assets that are going the same way, which is the oil and the oil currencies, because of the reason that, as I explained, that these countries are major oil exports. Okay, so looking at let's take a look at these currencies, and I want to answer your questions in just a second. Okay, so USD versus ruble, daily chart. See, the ruble is getting weaker, which means the US dollar, the major currency here, is getting stronger. Ruble goes down when oil is going down. USD versus NOK, you'll see the same thing, I guess. Let's take a look. There you go. Goes up, okay, which means the NOK is getting weaker. So the dollar is stronger versus the NOK because of oil drops. And the last one was the US dollar versus the Canadian dollar, which I'll find here, I guess, is doing the same thing. Oil drops, Canadian dollar is getting weaker, so the US dollar is stronger. Okay? Are we good? Any questions? Okay. I see you have some questions. More correlating pairs. Actually, I just talked about the correlation between your question, Kathy, was, are there more correlation pairs? Yes, we have the correlation between these you can trade, for example, you'll see the same thing if you trade on the euro versus the NOK, for example. Okay, so if we go to the euro versus the Canadian dollar, I just found it here. Okay, you'll see the same thing. It goes up when oil goes down. Okay, because of two reasons. Actually, the euro is getting strong because of all other reasons. Okay, the QA system, and we're not going to go into it in this webinar. But the oil currencies are getting weaker when oil is getting. I just want you to understand the correlation between them, and we have gold and the US dollar with opposite correlations. If we talk about, actually, gold is the safe haven of all major currencies. Remember the Brexit? Okay, when we had the vote, actually the Brexit didn't take place yet. But if we go to the pound versus the US dollar, and I take it on a daily chart, Okay, and I want to go back all the way to June of 2016. You see, this is the Brexit. This is the UK referendum when the British have decided to leave the EU. So the pound dropped. Okay, when such a major currency is dropping, the price of gold is going up. So if we go to gold, we'll be able to see that it went up exactly the same day. Okay, because I have to sell my pounds, I have to put my money somewhere. Safe haven. So a lot of people traded the British pound versus gold. All right, great. Okay. So we talked about the oil currencies, volatility or VIX index, and safe haven assets. When volatility rises, okay, the VIX goes up as well as safe haven assets. Let's try to understand it, right? The VIX is what we call the index of fear. Okay, take a look at the market. Okay, if I take a look at the doesn't matter. Let's take a look at the major indices. Dow Jones on a daily chart. Go live. Okay, it went down. The market didn't. We talked about it on the last webinar. What are the reasons? The bonds for 10 years, and we were afraid of inflation. When we saw that the bonds for 10 years are 2.8%, 2.8, and then the U.S. Stock market dropped down. Didn't make the recovery yet. Okay, we have different opinions about it in the market, all the analysts, but you can see it dropped down, so the VIX is very high. Okay, the index of fear. If you go to the VIX, which gives you a lot of tells you a lot about the volatility, you can find it. You should find it with the indices here. Let's take a look. Let's go V. There you go. Okay, a VIX on a daily chart. Okay, this is a big wow. Look at it. It was somewhere between 11 to whatever 13, 14, and then went up like crazy and down like crazy. And right now, a lot of volatility on the VIX index itself. Okay, we had a lot of fear, and then the market stopped dropping down. So VIX was traded lower. Right now, it's traded 20, which is very, very high. It was it was like 26, 27 points. So when VIX is traded higher, we expect a lot of volatility, like in these days, because of many reasons. Okay, so as we said, when volatility rises, the VIX goes up, as I showed you, as well as safe haven assets. Safe haven assets include the US dollar, Japanese yen, Swiss franc, and gold. Okay, these are the major assets out of my experience that have very, very high volatility. Now we need, okay, when I always say a smart trader is a trader that works with a big portfolio, is for two reasons, and these two reasons has to do with risk management. The first one, as we said, diversify your portfolio. If you understand how to trade events, how to do technical trading, and if you understand what I'm showing you in this webinar, the correlation, the negative and positive correlation between assets, which means you know how to trade. Okay, now when you know how to trade and you understand that if gold goes up, dollar goes down, and you know, and the opposite, and you understand the correlation between the oil currencies, for example, and oil, and you understand the correlation between the assets in the market. So, so it means first of all you got to do the diversify, which means you need a bigger portfolio, and the other reason is for margin. Okay, high volatility, you need more margin, because if the market goes up and down with a bigger movement, as usually, which this is what high volatility is all about, when VIX is high, when we have main events, okay, a lot of things going on in the world or whatever, you're going to need more margin in your portfolio in order to trade it, because sometimes the market goes a little bit against us and then with us. So um, risk management. Okay, safe haven assets include these assets. Demand for safe haven assets rise when the market is unstable. Okay, when people don't know where to invest, when the US stock market is going down, when US dollar is going down, gold goes up. Okay, uh, for when the US market goes down, the US dollar is getting stronger, as we saw. Okay, look at this. I showed you. Look at this. S&P represents the 500 stocks with the highest value in the United States, daily dropping. Going to the US dollar. Okay, US dollar is dropping with the US market, which means that we expect gold to go the other way in the past few days. You see, in the past few days, the reason for the gold, the gold went down is actually, which wasn't so typical. Okay, at the beginning you saw that the US market fell down and then gold went up, and then it went down a little bit because of the reason that people have decided to take the money off the safe haven gold and buy stocks back. And then you can see in the past few days the stock market is a bit more stable, but still we don't know where it's going, so help to follow that. All right. The Let's talk about the stock market. The FANG, the Facebook, Apple, Amazon, Netflix, and Google stocks. The FANG correlation. These are the major technology. If you take these five stocks, okay, their market capitalization, what they're worth, is over $3 trillion. We're talking about the economy of almost Germany, France, the whole country. Okay, only in five companies, US companies. So the FAN correlation is the biggest stock correlation in the market. These companies have a strong positive correlation. They have great reports in the past few seasons, and that's because they're all based on the same thing, which is internet shopping, advertising, streaming, and cloud storage are responsible for the correlation. Okay, so all of them. If you take these five stocks, let's take a look. If I'm taking Google, okay, it had a bad report, but if I look daily, you can see, or going weekly, okay, you will be able to see that Google is going up on a weekly chart, okay, or daily. Okay, forget the report. The last report was bad for Google, but and this is why we need, by the way, to diversify our portfolio, because if one stock goes against us, we have the other. Okay, look at Apple. Okay, had a bad report as well, but still on a daily chart, it's going up. All right, take a look at Facebook. Same thing, going up. Take a look at Netflix, technology stocks. So you see it's going up. So they're all very, very high correlated if you want to build such a portfolio or take this package of the technology. So they correlate on the same way. What's going on right now? Now, oil is dropping last 2 weeks, as I showed you. Therefore, the ruble, CAD, and NOK are dropping as well. Showed you, right? The US RUB is going up, the US CAD is going up, the US NOK is going down, while oil is dropping. VIX is rising, I just showed you, and pushing the Japanese yen and US dollar higher, although gold is not rising right now. The drop in gold prices is related to the much stronger US dollar, even though volatility pushed higher. Okay, the drop in gold prices. Okay, what is the reason that gold is going down? All right, because the US dollar is stronger, and we talked about the opposite correlation between them, even though volatility pushed higher. The main reason for this is the reason for volatility, which is inflation and not any geopolitical news. If we had some news from North Korea, for example, all right, so it's going to affect you like bad news. I'll just give you an example, which is a geopolitical reason. You're going to see the US dollar drops and a safe haven asset like gold is going up. Okay, but this time it was because of financial reasons, because of people afraid of inflation, prices to go up in the US, which means more interest rate hikes, which means money will go out of the stock market as we saw and go into the US dollar. So gold didn't react as we expected because of this reason. All right, and of course, good luck. Any questions, guys? Did you get the idea of correlations? Okay, so we have positive correlations and negative correlations, depends on the assets. This information is supposed to help you out, guys, with your trading to understand how to diversify your portfolio, what asset is going with what, okay, and how it works. Hopefully, it was helpful for you. Okay. Okay. We good? All right. So I would like to thank you very much for participating. I'm going to be here next Tuesday at the same hour talking about the next topic. You're more than welcome to join me. I think if you take all these webinars, okay, and take it one by one, and you can find them on Facebook on our homepage, you can learn, I hope, a lot about how the capital market works in general to understand how to trade events, and hopefully it's going to be very helpful for you in the future with your trading. I would like to thank you very much for participating, and wish you a great evening. See you next time. Bye.